Hello everyone, Assalamu alaikum wa rahmatullahi wa barakatuh. Glad you all made it. Good evening everyone and welcome. For those joining us for the first time, I'm Dr. Tamer Alsayed. So let me tell you a little bit about myself. I see like a lot of new people joining us today and I would like to introduce myself again. So I've spent more than 20 years working in finance, investment, strategy, and startups, helping companies raise money, grow, and make better business decisions. And honestly, that's why we created ExecuFinity. Because between me and you, because I saw a big gap between what people learn and what actually happens in real business and investment meetings. So ExecuFinity was built to make finance, strategy, and leadership practical, simple, and real. Our first masterclass, you remember it was back in March about the CFO mindset. The second one was the startup funding. And today we close the loop. We continue with the investor pitch. Thank you all for being here tonight. Let's make this session practical, interactive, and valuable for everyone. I'm going to pause for 5 minutes to let everyone in and start in exactly 5 minutes. Okay? Thank you. Quick check, everyone. I want to see a thumb up if you can hear and see me clearly, please. I want to see it in the chat box. And the rules is that no questions during the session. No questions during the session. If you have a question, you will see to your right side Q&A bar. Post your question over there and I will run through it at the end of the session. Okay, we have a lot of questions. We have a lot of case studies, so I believe we're going to cover all. I hope you all brought your coffee with you because it's going to be a very long night. Okay, that's my coffee. Stay ready. We have 2 more minutes to go. Thank you. Yes, this session is recorded. But again, if you want to get your certificate of attendance, you're going to have to practice with us, answer the poll question, and stay until the end. Okay, Bismillah ar-Rahman ar-Rahim. Shall we start? So, mastering the investor pitch. Mastering the investor pitch. Most pitches fail before the first question is even asked, not because the product is bad, not because the market is too small. They fail because the person at the front of the room is answering the wrong question. Investors are not asking, is this a great product? They are asking, is this a great investment? Those are two completely different questions. And most founders never figure that out. What we built together over the next 2 hours is a bridge between those two questions. You will learn to speak the language of institutional capital allocators. You will learn to frame your company not as a product, but as an investable asset allocation thesis. Every framework, every formula, every case study in this masterclass has one purpose. Keep that in mind, has one purpose: to make you dangerous in the meeting room. Again, please, I don't want to see any questions in the chat box. Post your question to the Q&A. Let's stay quiet, focus, and proceed. So we have 2 hours, 5 modules, and one outcome. You walk out tonight knowing exactly what stands between you and a term sheet. Module 1, the first 30 minutes, covers the psychology and mechanics of the pitch. We're going to reframe how you think about what a pitch actually is. What a pitch actually is. Module 2 takes us into the market sizing, unit economics, and financial interrogation. Financial interrogation, that's very important. This is where institutional investors do the most damage to unprepared founders. Module 3 is the core. It covers competitive moats. I believe we spoke about the moat before, but let me tell you what moat is. Moat is the reason competitors can't easily kill your business. Think about Apple. People cannot steal Apple identity. People don't buy only the phone, the iPhone. They buy the ecosystem, the brand, and loyalty. Think about Uber. The more drivers and users join, the stronger the platform becomes. That's a moat. Investors don't just ask, can this company grow? No, they ask, can this company stay strong when competition attacks? So in Module 3, we cover competitive moats and valuation methodology. Not feature checklist, structure, economic barriers, and how to price them. Module 4 is about live delivery, Q&A dynamics, and the institutional close. The room you are in, the question you will face, the answers that when, all of it. Module 5, what happens in the 8 weeks, 2 months after you leave the building, after you finish or after you deliver your pitch. Because most founders treat the pitch as a finish line. No, it's not a finish line. It's not, trust me. It is the starting gun for a process that is won or lost in the data room. We have case studies, we have quizzes, and worksheets run through every model. Not as a decoration. Don't take a look at as a decoration. I want each and every one for the 2,000 attendees tonight to answer and to participate in the poll question. Okay? Let me walk you through this. Are you ready? Bismillah. Let's leave this for a minute and pass to Module 1. So what Module 1 is actually about? Changing the mental model you carry into every investor conversation. The objective of Module 1 is to rewire your pitch from a product demonstration into an asset allocation that de-risks macro and micro and execution vectors. Any risks. If you take nothing else from this module, take this. An investor is not your customer. An investor is not your customer. They are your capital partner. Speak to them accordingly. So, the asymmetric information gap, starting with this in module 1. Here is the structural problem at the heart of every failed fundraise. Founders know everything about their company. The product nonsense, the daily operations, the engineering trade-offs, the customer conversations. They have been living inside this business for years. That's the founder. But what about investors? Investors know almost nothing about your specific company. But they know an enormous amount about macro markets, sector dynamics, portfolio construction, capital allocation, and risk-adjusted return profiles across hundreds of comparable deals. So when those two people sit down in a room, founder and investor, what actually happens? What actually happens? The founder tries to explain the product, and the investor tries to what? To underwrite the risk, to underwrite the risk. And they never actually connect. They never actually connect. And that gap between deep operational knowledge and deep macro capital awareness is the asymmetric information gap. In private equity, PE, and VC venture capital and corporate M&As, this gap is the primary barrier to transaction execution. That's why it failed. Not the product quality, not the market size, the communication failure. So the pitch is not a presentation. Again, it's not a presentation. It is not a demo. It is a bridge. So again, a pitch is a bridge between the founder and investor. It is constructed to and designed to close the information gap from both sides. Your entire job in that room is to give the investor enough verified operational insight that they can make an informed asset allocation decision. This is what a pitch actually is, a bridge. So how do you make the shift, mindset shift from product to asset allocation, from product to asset allocation? Investors are not buying your software to use it. They are not your customers. They are buying equity in an economic engine. Your company is an economic engine. Many founders construct their pitch as an extended feature demonstration. This approach makes one fatal assumption that a superior product automatically translates into a superior investment. It does not. It does not. Trust me. Features live in product reviews. Investment live in financial models. Stop selling features. Stop presenting an investable asset. The old way, we sell software capabilities. The new way, presenting a scalable economic engine that generates verifiable returns within a specific time horizon. So you need to structure your pitch around three framing pillars. Three framing pillars. Take notes if you want, but capture this. And if you want to take a screenshot, take a screenshot. The three framing pillars are risk mitigation, return drivers, and milestone capital. Risk mitigation, defending against market and execution risk with specific documented evidence. Return drivers, proving unit economics and scalable margins at the transaction level. And the third one is the milestone capital. You need to tie your specific capital ask to the precise valuation inflection point it will unlock. Why do you need the money? Why are you raising capital? So when an investment committee sees your deck, your pitch, the question running in every partner's head is, if I deploy capital here, if I deploy capital today, what is the risk-adjusted return? And when do I realize it? Now, later, in a month, in 6 months? Your pitch must answer that question. Don't let them guess, okay? Don't let them guess. Not somewhere near the end from the very first slide. So we have three foundational de-risking vectors. Every investment decision is fundamentally a de-risking exercise. An investor is not asking, can this company succeed? They are asking you as a founder, what would have to go wrong for this to fail? And how likely is each failure mode? There are three vectors of risk that every allocator evaluates simultaneously. First is macro viability. Does the external market environment support a scalable business right now? This means that market tailwinds, identifiable macro shifts driving long-term adoption, and market timing, a clear specific answer to why now, grounded in technological or behavior inflection. Second is micro performance. Does the internal financial engine of this specific company actually work at the unit level? Sustainable unit economics, payback periods, pricing power, the ability to maintain or expand gross margins against competitive pressure. And the third one is the execution architecture. Does your team, have the operational rigor to deploy capital efficiently and hit projected milestones? Your plan. Can you meet your plan? Can you meet your target? Leadership capabilities, governance frameworks, operating cadence. Leadership is like domain expertise, prior exit history, operational advantages. Speaking of governance, board structure, reporting transparency, risk management policies, and operating cadence, systematic KPI tracking, iteration cycles, scaling execution. So, again, a great pitch de-risks all three vectors. A weak pitch ignores two of them and hopes the third carries the room. It does not. Your pitch is not an argument. It is a systematic elimination of doubt. Again, it is a systematic elimination of doubt and execution risk in that exact sequence. So getting to the core. How do you construct your slides? 12 slides, not 15, not 30, 12. And the sequence is as important as the content. The sequence is as important as the content. Slide 1, hook and vision. One sharp value proposition. This roots the company in a clear macro theme and a secular tailwind, not in a feature announcement. That's first slide. Second slide, the problem. This is where most founders make their critical mistakes. I call it fatal mistakes. The problem slide cannot say the current process is inefficient. That is a feeling, not a finding. There is a difference between a feeling and a finding. It must quantify an economic leak. Dollars lost, revenue destroyed, cost misallocated, a specific, measurable destruction of value in an identifiable industry. Okay? Slide 3. What are you proposing to fix the problem? The solution. One rule. Your solution must directly plug the exact economic leak you defined on slide 2. If it does not, you have a product, not a solution. Again, it should plug the exact economic leak you defined on slide 2. And then slide 4, the market timing. This is where you answer. Why now? Why now? Sudden regulatory shifts, major technology inflections, critical consumer behavior changes, something structured that did not exist 3 years ago and makes your window uniquely valuable today. That's why market timing is important. Let's do 5 to 8. And the middle 4 slides are where financial credibility is built. The middle 4 slides are where financial credibility is built. Or what? Let me hear it from you. Or destroyed. Or destroyed. Slide 5. TAM and market sizing. Total addressable market. Okay. Transparent. Bottom up addressable market calculation. Top down speculative percentages. We only need, let's say, 1% of 200 billion market. That will be dismissed on site. We will spend significant time on this in module 2, by the way. Slide 6, product and technology. You're gonna have to have a deep dive into proprietary intellectual property, your IP, technical architecture, and the factors contributing to long-term operational defensibility. Not a feature list, again, not a feature of the product. I need advantage narrative. Slide 7, business model. Specific revenue streams, pricing mechanics, and historical unit economic margins. The word historical here matters because projected margins are a story. Historical margins are evidence. Okay? Projected margins are a story. Historical margins are evidence. And then your slide 8, the go-to market. A repeatable, scalable distribution engine. Repeatable, scalable distribution engine. Acquisition channels, velocity metrics, sales cycles. If your GTM slide or go-to-market slide says social media and word of mouth, you are not ready for any fundraise or investor to invest in you. Eliminate it from your pitch. These 4 slides answer the financial engine question. How does value get created? How does value get created, captured, and distributed to customers at scale? The final 4. The final 4 slides are where investors make their conviction decision. The conviction decision. Slide 9, the competitive landscape. A strategic positioning matrix based on core industry vectors, not a surface feature checklist. We will cover exactly how to build this in module 3. Slide 10, financial projection. A 5-year forward income statement summary detailing revenue drivers, revenue assumptions, gross margins, and EBITDA, earning before interest, tax, depreciation, and amortization. Not a spreadsheet, a narrative backed by a spreadsheet. They need to read, they need to listen to you saying the narrative backed by a spreadsheet because they're going to ask for it later when they do their due diligence, DD. Every projection must be traceable to a specific operational assumption. Slide 11, the team, your team. This slide is not a biography page. It's not your bio. It's an unfair advantage page. So again, your team show their domain expertise, prior successful exits, unique operational advantages that this specific team possess and competitors cannot replicate. You know what I mean? They cannot replicate or duplicate your team. And then slide 12, the ask and capital use, which is how much for what? How much for what? Fundraise target, allocation breakdown, runway duration, 18 months or 24 months, and the targeted operational milestones. The ask should feel inevitable by the time they reach this slide. Prep them for slide 12. If it feels like a surprise, your preceding 11 slides have not done their job. You're doing a lousy job. So, let me give you 4 things that will cause an investor to mentally check out before you reach slide 5. Checkout means exit the room before you reach slide 5. Top-down TAM, total addressable market, with arbitrary market share assumptions. Let's say if you said we are targeting a 200 billion market and we only need 1%. That is not analysis. That is hope wearing the disguise of analysis. Leading with a feature demo before you have quantified the underlying economic problem is not. You have not earned the right to show the product yet. Not now. And asking for capital before proving structured model, scalability, and unit economics, the capital ask must be earned. Must be earned. Evidence, not only excitement. And then over-indexing on team bios without presenting concrete operational traction proof. Credentials are table stakes. Results are the argument. The argument. Believe me when I say this, I have reviewed hundreds of pitches, of decks over 20 years. Every failed pitch I have seen contains at least 2 of these 4. Most contain all 4. Now we're going into our first case study for tonight, and we have many, okay? So, New Flow was a company that should have closed their Series A in 60 days. Instead, they spent 9 months in silence. Whenever you think of Series A or even a company raising fund, it means they have a runway of 18 to 24 months. Should be 18. So instead of 60 days, they spent what? 9 months in silence. NewFlow built an enterprise B2B SaaS platform that optimized supply chain handoffs. Real problem, real technology, real market. They were seeking $12 million at a $60 million post-money valuation. Again, they were raising $12 million at a $60 million post-money valuation. Their deck focused heavily on product architecture and engineering features. Every slide was a technical demonstration. Not one slide, not one single slide quantified the financial impact of the problems they solved. You remember we spoke about the problem and then solution, slide 2 and slide 3. And the result, weak traction with investors. Allocators could not bridge. Remember, your pitch is a bridge. They could not bridge the asymmetric information gap because there was no financial thesis to anchor. There was no economic leak, no verified TAM, no unit economics, just a product looking for a buyer. So go look and find a customer, not an investor, not a business partner, not a capital partner. So the technology was not the problem. The framing was the problem. And in the next 2 slides, we fix it. So, strategy pivot. We did not change the product, we changed the story. The problem, the leakage, and translated it into investors' language. You remember slide 2, the problem I just told you about a minute ago, was reframed from a vague operational complaint into a quantified economic leak. Keep these words. I keep throwing words at you. Try to remember it. Try to capture it. Try to take screenshots. I will be sharing this presentation after the course, but anyway, you need to frame your mind, rewire it again. The new version of the pitch deck said enterprise logistics operators lose 4.2 billion annually in deadweight economic loss due to legacy software downtime during freight handoffs. So, same problem, but completely different framing. Again, the story behind the problem and the solution. Now the investor sees a specific quantified value destruction. And who plugs it? Who plugs it? You, the founder, your product. If you go back to slide 5, TAM was rebuilt from the ground up. The formula number of tier 1 freight hubs multiplied by new flow's average annual contract value. And the result, 1.8 billion addressable market. Verifiable, auditable, and defensible. Verifiable, auditable, and defensible. And what have changed? We did not reinvent the wheel. We did not invent new numbers. We just translated existing operational reality into investment committee language. The company did not change. The product did not change. The bridge happened. The bridge happened. So again, if you do not have those numbers, you haven't had your homework done. Okay? So the outcome of new flow fundraising, 45 days. 45 days. That is how long it took for new flows round to become oversubscribed after the narrative was rebuilt. Same company, remember, same company, same product, same market. The only thing that changed was the frame through which investors saw the investment opportunity. By shifting from a product demonstration to a clear asset allocation, new flow aligned with how capital allocators actually process the risk. The reframed narratives de-risked the investment. De-risked the investment. The economic league gave the problem slide financial gravity. There is a solution. And the bottom-up TAM gives the market slide credibility. And together, they give investors why they should invest with you. 45 days is not luck. It's hard work. Okay? 45 days is what happens when you stop hoping investors will connect the dots. No. You should connect the dots for them. Okay, before we go to quiz number 1, are you ready? I want to see a thumb up. Again, have your coffee and stay fresh with me. Once I show the poll, you will see it on your right side. I expect everyone please, to answer. So in a minute, I will show you quiz 1 for module 1. Can you all see it? Can you all see the poll question? So start your answer, please. So the question says that when constructing when constructing the TAM slide, why do professional institutional investors heavily discount a top-down market estimation approach? I see a lot of correct answers and some wrong answers. Take your time. I'll give you 1 minute. Lock in your answers. We'll reveal them on the next slide. So, A, it assumes a fixed market share without verifying localized go-to-market channels or granular customer segments. B, top-down models are mathematically too complex for investment analysts to evaluate efficiently. Or it fails to account for changes in the consumer price index over multi-year horizons. Pick your answer. I'm having my coffee. Pick your answer. We'll discuss about it in a minute. Just to pick your brain. Just to pick your brain. All of you should pick an answer. We have so far 2078 attendees. 2078 attendees. I want to see 2000 selection. It will not take 1 second from you. I'll give you 1 more minute. We still have 4 modules to go and 3 more case studies. Dear all, look to your right side. Okay? Click on the poll icon on the right side of the chat. So hey, look to your right side. You will see like a chart or a graph. That's a poll question. Look to your right. Don't put your answers here. Pick your correct answer. That's all. Don't write it in the chat box, everyone. Pick the answer. That's why it's a poll question. Pick the answer. Okay, I've prepared actually 2 quizzes for module 1, but the time is crucial and we can't waste more time. So, again, the answers tell you something important, not just about the quiz, but about how investors think. Question 1, the correct answer is A. The top downsizing is speculative because it picks and like a percentage of a large market without verifying a single buyer, a single channel, or a single contract value. The bottom-up approach earns credibility by multiplying verified target buyers by realistic contract values, contract annual values. Option B is wrong. Top-down models are not complex. They are simple, which is precisely the problem. Option C is a distraction. Inflation is not the issue. Inflation is not the issue. It's irrelevant. You have not validated a single buyer yet. My dears, you have the poll question to your right side. Forget about it now. We're going to focus to move on to module 2. Please stop answering. You can answer later. Okay? Yes, Kareem, only one question. Only one question. We have no time. Forget about the poll question now. Let's focus with me here, please. Move on to module number 2. And before that, 3 things to carry out of module 1. 3 things to carry out of module 1. Not concepts, actions. First, you need to present an investable asset allocation strategy, not a product demonstration. Every word in your pitch should answer the investor question. What is the risk-adjusted return and when do I realize it? Not yours. Second, organize your story with the definitive 12-slide sequence framework. The sequence is important. It is the logical architecture of the underwriting. Third, the de-risk of the investment across macro and micro and execution vectors. And now moving to module 2, market sizing, unit economics, and financial interrogation, because it's really an interrogation. Okay? So module 2 is where institutional investors do the most damage to unprepared founders. They can kill you. Trust me, they can kill you in a minute. The objective is to build transparent market sizing and pass the audit on unit economics. Not estimate, not approximate, pass the audit, full mark. So by the end of this module, you will understand why 2 companies with the same revenue can have completely different investment stories, based entirely on how they calculate 6 numbers. 6 numbers. Now is the real deal. TAM equals N times P. 4 characters, the most powerful formula in your pitch. TAM formula equals N times P. So let's break it down. N is the number of unique verified buyers in your addressable universe. N is the number of verified buyers built from the ground up with documented data sources. Okay? P is the average revenue per user. So N is a number of what? Number of verified buyers. P is the average revenue per user or the annual contract value per buyer. Multiply those 2 numbers and you have a bottom-up total addressable market that an investment committee can actually underwrite. So most founders instead say the global market is 50 billion and we are targeting 2% of it. No. Again, they will kill you. Let me be direct. That number means nothing to an investor. Nothing. Zero. In and out. You have not shown me where the buyers are, how many there are, what they are willing to pay, or how you plan to reach them. So how to apply this? A bottom-up TAM says there are, let's say, 4,200 enterprise logistics operators in North America. Our annual contract value is 95,000. That is an addressable market, everyone, of 399 billion, reachable through a defined channel strategy over 36 months. Now, as an investor, I can underwrite that. Now I can test your scalability. Now I can test your sales capacity. Now I can trace the math, the numbers. I can verify the formula. Again, top-down TAM is a hope. Bottom-up is strategy. It's a thesis. Document every data source you have. Every number on that slide needs a footnote that survives diligence, survives or pass the audit. So SAM, SAM, and SOM, SOM. TAM is the ceiling. Try to visualize it. TAM is the ceiling. SAM and SOM are where the real conversation happens. Because SAM, serviceable addressable market, is a slice of your TAM that your product and geographic presence can actually reach. Okay? Again, SAM is the serviceable addressable market, is the slice of your total addressable market, the TAM, that your product and geographic presence can actually reach. Actually reach. Not a hope again. Geographic constraints, regulatory limitations, and the technological readiness of your target demographic all shrink TAM down to SAM. So the second term is SOM, SOM, serviceable obtainable market. It is the portion of your SAM. So we have TAM goes down to SAM, and then portion of SAM is SOM, serviceable obtainable market. So it is the portion of your SAM that you can realistically capture within the next 24 to 36 months. So now we have identified the milestone, the timeline, right? So given your current team size, your sales velocity, your pipeline conversion rate, your competitive density, right? So investors, they do not fund TAM. No way. They fund SOM, not even the SAM. So a SOM that exceeds your current sales capacity is a red flag. A SOM that exceeds your current sales capacity is a red flag. A SOM that understates your validated pipeline is a missed opportunity. Investor is calculating, given your team, given this capital, this market, can they realistically reach this SOM? And does that SOM justify the valuation or not? So again, think about it in this way. TAM, SAM, SOM. The portion that you can reach out and convert within what? 24 to 36 months. So the TAM gets you in the room. Some closes the deal. Okay? Getting more complicated here. LTV formula. LTV is the number most founders calculate incorrectly. And trust me, the auditors of your investors always check it first. The correct formula of LTV equals ARPU multiplied by your gross margin percentage divided by your annual churn rate. If you ask me, I know you're asking me now, what is ARPU? Which is the average revenue per user. Average revenue per user. It's your annual contract value or revenue per customer. And gross margin percentage is the proportion of that revenue that remains after direct delivery cost. It captures the true cash contribution of the revenue. So the churn rate is the percentage of customers lost over a specific period. Notice what most founders leave out, gross margin percentage. So LTV is not revenue. LTV is the actual cash contribution of that revenue after the cost of delivering the service. Can anyone tell me what LTV means? What does it mean? I want to see it in the chat box. What does LTV means? Yes, correct. Lifetime value, not lifetime value. Lifetime value. So let's apply it. Let's apply this. Okay. Let me work through this with real numbers. Think of it with me. Just listen to me. If ARPU, average revenue per user, 1,200 per year. Gross margin is 75%. Annual churn is 50%. Step 1 gross profit per user equals 1,200 multiplied by 75%. It gives me like 900. Step 2 LTV equals 900 divided by the 15%. The annual churn rate. The annual churn rate. That gives us 6,000. So now watch what happens when you skip gross margin. 1,200 divided by 15% gives you 8,000. That's misleading or overstatement by 33%. So LTV without gross margin is not just wrong. It is the kind of wrong that pulls term sheet out. Don't worry, you will get a question on it later. Don't worry. So CAC, customer acquisition cost. Customer acquisition cost. 3 letters and one fatal trap. Customer acquisition cost equals total fully loaded sales and marketing spend divided by new customers acquired in the same period. That's very straightforward and easy. Total fully loaded sales and marketing spend divided by what? New customers acquired in the same period. In the same period. And the key word here is fully loaded. Fully loaded means salaries including inside sales representative. It means commissions, marketing tools, creative costs, overhead allocations, something tied to acquisition. Every dollar spent to bring in a new buying customer is part of the fully loaded S&M. Misclassifying inside sales rep salaries, for example, as corporate G&A rather than acquisition cost is the single most common financial error I see in due diligence. It is a severe red flag because it's misleading, not because it's fraudulent. Most founders do it out of habit or ignorance, but because it tells the investor something worse than dishonesty. It tells them you don't understand your own cost structure because you should know it. If you don't understand your cost structure, how can you be trusted to deploy their capital efficiently? That is the question running in every partner's head when they find a misclassified expense. So the investor is not angry. They are just recalibrating their conviction in your operational competence. So you need to know every line item in your CAC calculation and be ready to defend every one of them. So now your operational guard rails, LTV divided by CAC ratio threshold. The LTV to CAC ratio is not just a metric, it is a verdict on your business model. So we have three criteria, as you can see it here. We have three criteria. If it's below 3 times capital inefficient, the business is destroying value in the pursuit of growth. You are spending more to acquire customers than their economic contribution justifies. And between 3 and 5 times, that's like the sweet spot. This range demonstrates strong product market fit and highly efficient go-to-market scaling. It tells the investor like every dollar spent on acquisition generates $3 to $5 of lifetime economic value. The LTV. What about above 5 times? No, it's not good. It's a warning signal. It's a warning signal. As this ratio management is leaving market share on the table by under investing in acquisition. Let's stay between 3 and 5. Because beyond 5, the business has room to grow faster and it's not taking advantage of it. Maybe I could be wrong about this in specific context. Some capital efficient bootstrap businesses run high ratio deliberately. But in fundraising context, a ratio above 5 invites the question, why are you not growing faster? Why are you not growing faster? So again, 3, 3 to 5, above 5. So 3 to 5, that is the range you want to live in, to abide by, and be able to defend line by line. And now with our second case study, MedTech Core. MedTech Core. I want you to take a look at this slide for 10 seconds. Read it out loud. Read it out loud. So A 6.5 times LTV to CAC ratio should have been the foundation of like a flawless Series B fundraise. Instead, it became the evidence that killed the deal. MedTech Core, a digital health platform, applied for a 30 million Series B to scale operations. And the executive team presented financial projections anchored by an LTV to CAC ratio of 6.5 times. And we said before, it's danger. Above the sweet spot. Visually compelling, audit ready, or so they thought. That's wrong, my dear. The metrics appeared exceptional on the surface. They moved immediately into deep financial DD or due diligence with the investors' auditors. That's exactly when the foundation cracked, shattered. The problem was not the business. The problem was arithmetic. And the auditors are very good at it. So what happened? You remember the word interrogation. The interrogation, it happens usually in due diligence. I love this case study. Auditors do not look at your slides, they look through it. Okay, they look through it. During financial due diligence, the auditors discovered two critical calculation errors, and that's a disaster. Error 1, CAC calculation. Inside sales rep salaries and commissions were excluded from CAC, wrongly categorized as corporate G&A, general and administrative expenses, rather than fully loaded marketing spend. We said before, fully loaded means something. And this alone caused true CAC to double. Okay, to double. Error number 2, LTV calculation. LTV was calculated by dividing raw ARPU directly by churn, completely ignoring the company's what? Gross margin, 68% gross margin. Every unit of revenue was treated as pure cash contribution. It was not. So two errors, both of them common, both are fixable if caught before the due diligence. But in live diligence process, they are not fixable. That's it. Mistake has happened and they are disqualified. So auditors look past surface level financial layouts to verify that core unit economics formulas capture the true economic reality of cash flows. So the rule here is simple. Do the audit on yourself before they do it to you. Audit yourself before they do it to you. So the recalculation and outcome. From 6.5 times to 1.9 times. Under 3. You remember? Under 3, 3 to 5 sweet spot, above 5 dangerous. That is the distance between a term sheet and a termination. Okay? Adjusting for fully loaded metrics, true CAC doubled from 400 to 800. And true LTV compressed significantly once the 68 gross margin was factored in correctly. And the resulting LTV to CAC ratio 1.9 times. It's very way below the floor of 3. So the investor, they pulled the term sheet, the transaction was terminated due to systematic misreporting and poor unit economics. So it's not a story about dishonesty. The founders believed their numbers. They had never been through due diligence before. But in my own perspective, ignorance is not a defense in an investment committee room. You are immediately disqualified and terminated. So you should know your formula, check every component, and audit yourself before they audit you. Okay, now you all know the drill. Go to your light side and answer module 2 quiz. Module 2 quiz. I will hide now module 1. Okay? Now module 2 is visible. Please. So module 2 calculates the exact LTV given the following operational parameters. Okay, ARPU 1,200 a year, gross margin 75, annual churn rate 15%. The same case study we had a minute ago. I'll give you 1 minute to do the calculation, and I hope I see only correct answers. I hope. Okay? So again, the formula is the gross profit per user multiplied by the 75%, okay, divided by the 15%. You do the math. Oh, we have one mistake here. We have one mistake here. And you know yourself. No, we have 3 mistakes now. Come on, people. I think you need more coffee. Yes, like 90% are correct. Perfect. You just made my day. You just made my day. Not my day. My night. My evening. Continue. We still have like 30 seconds to go. And we still have 3 more modules to go. 3 heavy modules. Especially module number 5. Yeah, we're going up. 91% are correct. 10% margin I can live by. Okay. I'll give you 10 more seconds. Okay, everyone, stop please. We have 93% selected A and 3% selected B and 5% selected C. So we all know the answer, 6,000. 6,000. Because again, if you do the step-by-step calculation, gross profit per user, 1,200 times 75%, which is 900. So your LTV is 900 divided by 15% equals 6,000. Equals 6,000. Why other answers are incorrect? Because they are incorrect. One of them omitted the gross margin and the other one just incorrect. So how or what to show on a KPI dashboard? Your KPI dashboard is the first thing a diligence team opens. It tells them everything about your operational maturity before they read a single projection. Give me a minute, please. And those 6 metrics belongs on every dashboard. ARR, MRR, they are the annual and monthly recurring revenue run rates. These are your top line polls. GRR, NRR, the gross and net revenue retention. Gross revenue retention, net revenue retention. And they show how well you hold existing revenue. Net revenue retention shows whether customers are expanding or not. So NRR above 100% means your existing customer base is growing without a single new sale. CAC, payback period, customer acquisition cost, payback period. Time in months to fully recover acquisition cost. So if you are below 12 months, signals efficient capital recycling. Above 18 months is a structural concern. And what about cohort retention? Stability and engagement curves by customer vintage. This is the most honest data in your entire deck. It shows what actually happens after a customer signs. Pipeline velocity and gross margin. Okay? Those are very important KPI dashboards. Module 3, the investor narrative linkage. How to link the metric to an English spoken person. So every metric on your dashboard must eventually answer one question. Why does this investor need to give you money right now? Now we speak like to their mind. TAM is more than a large number. It sets what? The operational boundary. It sets the operational boundary. So we have 4 economic modes to discuss. We have 4 economic modes to discuss. A feature can be copied in a quarter, a mode cannot. And we spoke about the mode before, correct? So most pitch decks include a competitive analysis grid. Check marks showing features you have that competitors lack. I've reviewed many of them. They tell me almost nothing about investment durability, because every check on that grid represents something a well-funded competitor could replicate by next year. A moat is a structural economic barrier. It's an economic barrier, a property of your business that makes it systematically harder for competitors to take your customers, your margins, or your market position. There are four modes that investors actually believe in. Okay? First one, the network effects. Platform value scales as user density increases. High switching cost. Deep workflow integration makes replacement operationally disruptive and economically painful. Scale economics. Your unit cost structure gives you a permanent gross margin advantage over smaller competitors. Entry to market, remember this. Intangible assets, patents, regulatory approvals, exclusive data sets, legally enforced structured protection. So a checklist grid shows features, a mode, you need to capture this, visually capture this. A mode analysis shows structured economics. So you should know which one you are presenting and how to prove it, how to defend it. So we'll take one by one. We'll go through all of them one by one. The first mode is the network effect. Metcalfe's law. The value of a network is proportional to the square of its users. Something complicated, right? Okay. So V proportional to N squared. Value to N squared. In plain language, a platform with, let's say, SaaS, a platform with 1,000 users is not 10 times more valuable than one with 100 users. It is 100 times more valuable. Again, a platform with 1,000 users is not 10 times more valuable than 100 with 100 users. It is 100 times valuable. Why? Because investors will not simply accept the claims that you have network effect. You have to prove user density. Demonstrate that increasing network participation actively reduces customer acquisition cost and improve organic retention. So in multi-sided platform, you must prove cross-side effects. An increase on the demand side should directly enhance value for the supply side, right? An increase on the demand side should directly enhance value for the supply side without disproportionate acquisition cost. So the most durable form of network effect is a data flywheel. More usage generate data, right? More usage generate data. That data improves your model. The improved model reduces onboarding friction for every subsequent user. Machine learning inputs improve. Feedback loops accelerate product value. Centralized data creates a barrier that cannot be purchased or replicated from scratch. We have a case study later in this module. It's called SecureX. It shows exactly how a data flywheel moat justified a premium valuation when macro multiples compressed across the entire sector. We'll take a look at it later. Second mode is the high switching cost. The most powerful switching cost is one the customer does not even think about until they consider leaving. So high switching cost exists when your product has moved from discretionary tool to a mission critical operational infrastructure. So think of it like deep integration into a client's core workflow. It makes replacement operationally disruptive and highly expensive. Migration friction is the direct cost of transition. Potential downtime. resource allocation, workflow interruption, and the organizational productivity loss during a changeover period. Again, contract lock-ins create an economic barrier. Extended multi-year agreements, structured upfront deployment. Speaking of training and data, probability compound the cost further. If you retain an entire organization staff on a new system, destroyed immediate productivity. Historical data mapped in proportional formats makes migration both technically challenging and operationally risky. And the clearest evidence of high switching cost is net revenue retention above 100%, NRR. NRR above 110% is the signal that customers are expanding, not churning, not running away. That the product has become structurally embedded, important. So you need to show contract terms, show NRR, show integration depth. And those three things together prove that leaving you will cost more than staying with you. So mode number 3, scale economics. Scale economics. Scale economics are the modes that get stronger every time you grow. That's why it's called scale. As production or user volume increases, fixed operational costs distribute across a larger base, which means it decreases, right? Each additional unit becomes cheaper to serve the whole production. Your unit cost declines systematically. So greater scale empowers better procurement terms with vendors and suppliers. Because with large volume commitments, you secure lower variable cost, preferred terms, or even exclusive access to key resources. So the result is scale justifies investment in an automated onboarding infrastructure, and it reduces the marginal labor and time required to acquire and activate each new buyer sharply. So the ultimate expression of scale economics is what I call the parity pricing trap, for your competitors. If competitors match your price, they bleed cash while you generate profit because you have the know-how. If they maintain prices to preserve their margins, you capture market share at a lower price point. Either way, you win. So when an investor sees this structure, a business gets harder to compete with as it grows, as it scales. So the moat is not what you claim, it is what your cost structure proves. And then mode number 4, the intangible assets. The intangible asset. It is a legally enforced structured protection. It is not competitive advantage, it is a competitive barrier. And the primary categories is regulatory approvals, IPs, and exclusive data rights. An FDA approval that took 3 years and 40 million to obtain is not something a well-funded competitor can replicate overnight. Correct? A patent portfolio that covers core technical architecture creates legal barriers to direct replication. Exclusive data partnerships or training data sets represent informational moats that cannot be purchased on the open market. But again, investors are complicated. They require more than a checklist of fillings. They require concrete proof that intangibles provide a sustainable advantage, not just an initial registration. So in modern software, exclusive data sets form a massive intangible barrier. Think of it this way. Bring 4 pieces of evidence to diligence: enforcement history, renewal timelines, regulatory approvals in place, and clear chain of title on exclusive datasets. So filing a patent is not a moat. Defending it, renewing it, and building your business around it, that is moat. Okay? Defend it, renew it, and build your business around it. That's your moat. That's my favorite part. Valuation methodology alignment. Valuation methodology alignment. Valuation is not a negotiating position. It's a financial constraint on both sides of the table, the founder and the investor. For growth stage companies with meaningful ARR, use comparable companies analysis, CCA, comparable companies analysis. This benchmarks your valuation against comparable public peers and recent private M&A transactions. Using multiples like enterprise value over ARR or enterprise value over EBITDA. CCA, comparable companies analysis, anchors your valuation in observable market reality, not in a spreadsheet with vague check marks, okay, or something you built yourself. When you defend the premium multiple, because your NRR is like 118% while the peer set average at 105%, you are making an argument, something you must defend. So structured mode justify premium multiples. That is the explicit investor logic you must unlock. For early stage companies, use the venture capital method or the VC method. And it's very easy formula. Post-money valuation equals terminal value divided by 1 plus the required ROI. Post-money valuation equals terminal value divided by 1 plus the required ROI. Raised to the power of T, where T is time to exit in years. Time to exit in years. So let's apply it. This method calculates the maximum post-money valuation a VC can accept today and still hit their return target at exit. If you exceed that ceiling, you have mathematically eliminated their ability to generate an acceptable return. They will not fund you, no matter how compelling the product is. Okay? So let's do the math. I will walk you through this formula with real numbers because abstract math is useless in a pitch room. The formula again is post-money valuation equals terminal value divided by 1 plus ROI raised to the power of T. T is what? T is where the time to exit in years. The formula again just in front of you. Okay? And this calculates the maximum current valuation an investor can accept today to hit their target returns in the future. And it accounts for 2 realities: the high risk associated with early stage growth and the compounding time value of capital over the investment period. And we have the scenario in front of us. Okay? Expected terminal value at exit is 200 million. 200 million. And the VC required annual ROI of 40%. Time to exit is 5 years. Step 1, you calculate the denominator. 1 plus 0.04.0. The 40% ROI rate to the power of 5 equals 5.378. 5.378. Step 2, you divide the terminal value by the denominator. So 200 million divided by 5.3 equals what? 37.2 million. Read it again. So if you, as a founder, if you walk into that room asking for 60 million post money on the same terminal value assumption, you have eliminated the investor's return. Mathematically, you have eliminated the investor's return. So you need to do this calculation before every investor meeting. You need to know their ceiling before you name your number. And now we have our third case study, SecureX macro mismatch. SecureX was a well-built company caught in a market that had moved against them. SecureX, an enterprise cybersecurity provider, you can say it or understand it from the name. They were raising a 25 million Series C when the macro multiple compression hit. Broad market SaaS multiples had fallen from 15 times ARR down to 6 times. Less than 50%. Okay? On standard comparable company analysis CCA, SecureX was staring at a significant down round, which would destroy the valuation and destroy also the existing shareholder value and signal weakness to the market. And most companies in this position do one of two things. They lower the round size or they delay the time. They either lower the round size, they ask the ticket, or they delay the timing. And SecureX did neither. They did neither. So what was the strategy? SecureX team understood something most founders miss. Most justify premium multiples even in a down market. So rather than accepting standard market 6.5 multiples, the executive team reframed their competitive narrative entirely around their data network moat. They demonstrated that every new enterprise client added behavior threat data to their centralized machine learning threat engine, which reduced the onboarding cost for all subsequent users. And this is a compound structure advantage. It grows with scale. It cannot be replicated from scratch. They then presented their net revenue retention NRR 118%. Not 100%, not 105, 118%. And this means that for every 100 of revenue from existing customers at the start of the year, they generated 118 by year end without acquiring a single new customer. That is the evidence of high switching cost, deep integration, workflow dependency. Customers were not just staying, they were expanding. Okay, the data flywheel mode plus the 118% NRR together made what? A structured case for a premium multiple above the market average. Even if the market is down, you can still justify it and build your story around it. So what is the resolution? What is the resolution? SecureX closed the 25 million round at a flat valuation relative to their previous cycle. In a market where comparable SaaS companies saw 40% haircuts, they held their price. by just shifting the narrative away from standard market multiples and focusing on their data, their moat and exceptional retention metrics, the 118%. The investor was no longer comparing SecureX to the SaaS peer average. They were evaluating a differentiated asset with premium retention and compounding data advantage. And the result, 25 million raised, stakeholder equity protected, down round avoided. So this outcome is a proof that moats are not just defensive tools. Now, module 3 quiz. Again, you know the drill. I will unhide now module 3 quiz, and you should do the calculation. Start. A company expects to exit in 5 years with a terminal value of 200 million. If a VC requires an annualized ROI of 40% on their investment, what is the maximum post-money valuation they can accept today? So we have the exit time, 5 years, the TV, 200 million, and the ROI, 40%. You know the drill, go for it. I even still remember the answer. You don't have to overthink it. Do the math in your mind and pick the correct answer. I'll give you 1 more minute. We still have 2 more modules. Okay, I expected this. We have improved by a very long shot. Okay, so the correct answer is A. Obviously, step-by-step calculation shows you why. The post money valuation 200 million divided by 1 plus 40, the ROI, and then power to the time. Okay? Stop answering now. We'll go to module 4. Bismillah. Delivery, Q&A, dynamics, and how to close. So we have a situation. If an investor just asked you something that makes you want to get defensive, this is not the moment to defend your product. This is the moment that decides whether you close the round or not. Okay, whether you close the round or not. The active Q&A framework, 3 steps, always in this sequence. Step 1, acknowledge and reframe. Take a screenshot, take a visual capture of this slide. Step 1, you acknowledge and reframe. You validate the concern directly, not with fake enthusiasm, but with genuine intellectual respect. Acknowledge and reframe. Okay, you need to remove the tension and signals that you manage risk rather than hiding from it. Step number 2, anchor in data. So step 1, acknowledge and reframe, accept it. Step 2, anchor in data. Pivot immediately to evidence. Okay, not promises, evidence. Audited operational metrics, historical cohort data, verified financial assumptions. Use the exact figures. You need to cite your source. If you do not know the precise number, don't guess. Trust me, don't guess. Commit to a 24-hour follow-up. So, the first one, acknowledge and reframe. Second one, anchor in data. Third, bridge to strategy. Connect your answer back to the primary investment thesis and the long-term growth plan. You need to show how the capital ask directly addresses the concern they just raised. Okay? The Q&A session is not an obstacle. It is the final underwriting event. So how to acknowledge and reframe? How to acknowledge and reframe? Your instinct is to defend. The discipline is to validate. Step 1 requires you to directly acknowledge the core risk or financial concern the investor just raised. Okay? Don't spin, don't hide. To be direct is be mature. Acknowledge the risk. You are absolutely right to focus on that. This single sentence removes conversational tension. So if you said you are absolutely right to focus on that, it removes the tension and shows something critically important. You know your own vulnerability. A founder who cannot name their own risk is far more dangerous to invest in than one who acknowledges them directly. And here is the contrast. Don't say, no, that won't happen because our product is great and our team is experienced. X, get out. The correct statement, you should say, you are absolutely right to focus on customer concentration Managing that specific risk is a top operational priority for us. Okay? Note the difference. The right response does not argue, it reframes the concern from an emotional attack into a shared risk management priority. So acknowledge and reframe. Once you validate, you shift from what? Against to supportive. Now you are both looking at the same problem. You are aligned and you are about to show them the solution. Validate every time without exception. Validate, validate, validate. Don't be defensive. Okay? Data, 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 data. So, after you acknowledge, you pivot immediately to numbers. The core action, once the investor concern is acknowledged, immediately pivot the conversation to evidence. Okay, how to reference, what to reference, audited metrics, your LTV, your CAC ratios, verifiable gross margin, historical velocity, NRR, churn trends, account expansion. You have verified assumption, pricing logic, conversion rates. Be precise, use exact figures, cite sources, provide context, and do not guess. A data-driven answer that is one day delayed is more credible than a guess. Trust me. So the first was acknowledge and reframe. Second, anchor in data. And the third is bridge to strategy. Bridge to what? Strategy. And here the answer does not end with a bridge back to strategy is an incomplete answer. After you acknowledge the risk and anchor in data, smoothly transition the narrative back to your primary investment deal. Show them how the requested capital directly mitigates the identified risk through a specific operational milestone. I'll give you an example. This is precisely why our current 10 million raise is explicitly focused on so and so. To ensure that metric stays stable as we scale, the primary execution milestone for this round is X. We proactively anticipated that challenge, which is exactly why our 18-month architecture plan includes XYZ. Notice what each of these phrases does. It converts a risk acknowledgement into a capital justification. You're buying them in. You're buying them in. The concern becomes the reason to fund. The concern becomes the reason to fund you. So the bridge you just created generates immense confidence among the investment committee for three reasons. Proactive leadership, validation, and de-risks execution capability. So how do we manage investor red flags? 3 red flags appear in every pitch. You need to know them before you walk in the room. Red flag number 1, your projected margins seem significantly higher than industry average. What they are testing is your financial model grounded in structural reality, or are you oversimplifying future costs? The recommended response: decompose your specific operational advantages, automated onboarding, unique supply terms that structurally justify the margins. Red flag number 2. What happens if a major technology player copies your core features tomorrow? What they are testing right now: how deep are your customer lock-in mechanism and distribution modes? What I recommend is to focus on high switching cost, IPs, data advantage, and your speed of product iteration rather than feature superiority. Red flag number 3. Your executive team seems to have high turnover in recent years. Now they are attacking your team. What they are testing are their underlying governance issues or culture dysfunction. You need to address the changes directly. Frame them as evolution to bring in specialized leadership for the next growth stage. 3 questions, 3 responses, all follow the same architecture. Acknowledge, anchor data, bridge to strategy. Margins and industry, red flags. So, the moment an investor says your margins seem too high, most founders get defensive. I know it's your baby, it's your company, it's your startup. And that's the wrong move. The concern behind the question is your financial model realistic, or are you misclassifying COGS to artificially inflate gross margins? The first level response decompose operational advantage that justify the margins. You need to justify the margins. Automated onboarding, which eliminates labor cost your competitors carry. Unique supply terms, technology architecture. Again, justification. The second level of questions, which is the follow-up that investors always ask. Incumbent operate at 60% gross margin, yet you project 85%. Are you misclassifying COGS versus OPEX? That's a direct hit. Now they're attacking you. So the response is you need to present a clear, audited COGS breakdown showing exactly how you allocate them, how you allocate technology, how you differentiate between COGS and OPEX. Okay? The third level. Will these premium margins hold as you scale and face pricing pressures or not? So you go back to data, you show historical cohort, margin stability over time, and provide what? Sensitivity analysis. You need to demonstrate margin resilience under various pricing pressure scenarios. Premium margins are defensible if you have the structure, explanation, and cohort level evidence. And you must listen to this. Never apologize for superior margins. Explain them. Okay? This one is funny. Big tech could copy you, right? It happens. Every founder dreads this question. What happens when Google does this? Since AI came into our life, every day we hear there is a new AI tool. Started with ChatGPT, and then Manus, and then Google Gemini, and now Claude is on top. DeepSeek, Grok. Here is what the experienced founder understand. The question is not about Google, it's about your moat. Your moat. The underlying concern, how deep are your customer lock-in mechanism and distribution advantage? So why won't your current customers just migrate to their new free tool? Your response, you need to emphasize high switching cost. It's better if they stay with us. Okay? Second follow-up. Big tech has massive distribution. What protects your core? Again, the data sets, the data flywheel, the dedicated distribution channels, they cannot easily replicate overnight. Whatever you accumulated over years of deployment is not something a tech giant can build in a sprint. So let's say the third follow-up, they can assign 100 engineers to clone this tomorrow. So in here, you need to showcase iteration speed and rapid product development cycles that outpace the process of large incumbents. The advantage of being small and focused is velocity. Use it as moat argument. If you look at it as a pattern in all three, you are not arguing that big tech will not try. You are arguing that your customers have structural reason not to leave, even if a free alternative appears. The moat is not about keeping competitors out, because they will come in one day. It is about keeping customers in. So what is the executive turnover they argued with you about? The leadership changes are not disqualifying. How you explain them is, okay? So the recommended approach has three components. First, you need to explain the intentional evolution for the next growth stage. The team that builds a product from zero is rarely the same team that scales it to 50 million ARR. Early stage operators are not always the right growth stage operators, and recognizing that distinction shows maturity. So do not hedge, do not blame market conditions. Frame each departure or addition as a deliberate decision. You need to outline your current hiring plan and operating cadence. You need to show the investors that leadership configuration is not reactive, it is planned. It is planned. They are not asking what happened. It is, does this team know how to build an organization as well as they know how to build a product? And it's up to you. You need to show them you are building a company, not just a product, a company, an entity, not just a product. And we have one more case study here. Corletic. Corletic was at 12 minutes into their 40 million gross round pitch when the managing partner stopped them. The executive leadership team at Corletic was pitching to an investor for a 40 million gross round. Then the managing partner interrupted. Your customer concentration report shows that 42% of your revenue comes from just 2 accounts. If one leaves, your business model collapses. That's an accusation designed to test whether your CFO, you guys, I believe 80% of you are CFOs, manages under pressure or cracks. So what was the strategy or the tactical response? Acknowledge and reframe. Always. The 3 steps. Acknowledge and reframe. Okay. Anchor in data. And then bridge to strategy. I don't have to read it for you. Acknowledge and reframe. Anchor in data. And bridge to strategy. And what was the outcome? $40 million approved. By utilizing the active Q&A framework, the CFO proved that the risk was managed, acknowledged the concentration risk while seamlessly shifting focus to the protective long-term contracts and strategic mitigation plan. This outcome is definitive proof of one principle. Composed, data-driven communication under pressure is not a soft skill. It is a deal closing skill. It is a deal closing skill. Okay? And now is the time for our fourth quiz. Read it until I show you the question. So, when an investor asks a challenging question about your competition, what is the most strategic approach for the presenter? I think all of you should pick the correct answer. A, minimize the competitor capabilities to make your product look superior. B, acknowledge the competitor's strengths, then use data to show how your product targets a distinct defensible market segment. Or deflect the question and quickly pivot back to your team slide. What would you pick? I'm waiting. I'll give you 2 minutes. We still have 30 minutes to go. MashaAllah, we're almost 2,100 live. 2,100 live. People, you should vote. You should vote. I'm going to give you 2 minutes. We still have one more module to go. One more module to go. Perfect. 100% correct. 100% are correct. You still have one more minute. Everyone, this is mandatory. Mandatory for the certificate of attendance. Okay? Let's see. Guys, you don't have to answer in the chat box. I told you vote in the poll question. Please, please. Okay. So the answer is B. Acknowledge and reframe, anchor in data, and bridge to strategy. Moving on to module 5. Okay, moving on to module 5. So what happens after the pitch? What happens after the pitch? The 8 weeks that decide the round. You need to know the process, what actually happens in the 8 weeks after. Decoding signals. You need to read the partner meeting in real time. Okay, and then you need to recognize the pattern. So what is the reality? Here is what actually happens after you leave the partner meeting, week by week. Week 1 and 2, partner debrief. The partner who hosted your meeting socializes the deal internally. So you need to expect a follow-up question list within 5 business days. Typically 3 to 7 questions focused on TAM assumptions, churn methodology, or unit economics. Week 3 and 4, diligence kickoff. The virtual data room opens to the lead investor's diligence team. The cohort data, customer contracts, and management references are all pulled simultaneously. Customer reference call begin. At this stage, your deal competes for partner attention against 4 to 7 other live opportunities in the same firm pipeline. Weeks 5 and 6, the conviction build. The sponsoring partner stress test your pitch with 2 or 3 peers. Customer references are completed and scored. If your data room is clean and your references are crisp, a term sheet draft circulates internally. And then week 7 and 8, the decision. Investment committee, vote or partner consensus. The outcome is a term sheet, a pass or a defer. So deals are won or lost in weeks 3 through 6 on diligence quality, not in the partner meeting itself. So how do you actually create the data room hygiene? This slide is very important, by the way. Capture it, take a screenshot. You're going to have this presentation later with your certificate, but you need to memorize this slide. Okay? You need to build your data room the day you start your raise, not when the term sheet received or lands. So what goes inside? Financials, 3-year P&L, financial model, and cap table. Legal, incorporation documents, IB filings, key customer contracts, metrics, KPI dashboard, team, their bios, CVs, organization chart, options, schedule, if any. So your folder structure that works, I did it like many times before. 5 top level folders: financials, legal, product, market, and HR or team. Never go deeper than 3 levels. And you need to name every file with a date, topic, and version. Not version 2, version 3, or version 4. Never, never. Okay? Your data room is your second pitch. It runs in parallel with your first. And it should be equally prepared before, not after. So how do you actually read the partner meeting? After your meeting with 1 or 2 partners, the deal goes to a Sunday morning partner meetings, or maybe a Monday if they are out of Saudi. Every partner with a vote will scrutinize the opportunity, and you will not be in the room. You've left the building. Your champion has to sell it without you. So typically 5 to 10 partners plus principals Each one has effective veto power on fund deployment. Your champion is your advocate. Skeptics will prop the weakest points of your thesis, and decision makers will vote based on what they hear from both sides. Okay? Three signals from your champions that tell you a term sheet is coming. Send me your latest cohort data and pricing model by Sunday. Or can you draft a list of customer references I can call this week? What is the cleanest one-line answer to this hard question? So these signals from the firm after the meeting, we are working through it, means the deal has stalled. Push for specifics. What specific concern is unresolved? You need to read the signals. Do not confuse politeness for progress. So reference calls, both directions. It goes both directions. So every founder prepares customer references for their investors. Very few founders reference their investors back. And that is a mistake. That is a mistake. You need to pick customer reference. Pick names from the data room access logs, not the founder's introduction list. Talk to 2 to 3 customers the founder did not pre-coach. Okay? Authentic product love sounds like specific workflows, not generic praise. Prior investors call to prior investors and one investor who passed. The past call is the most valuable signal. Portfolio CEOs for the VCs get references from 2 portfolio companies that hit a bridge round or a down round. Anyone looks good when the market is rising. Again, I could be wrong about this for every investor. Some firms are genuinely exceptional partners in adversity. But the one only way to know is to ask the portfolio CEOs who have been through it deliberately. Remember, as a founder, you're not just raising capital, you are choosing a partner for the next 5 to 7 years. You need to reference them accordingly. And now the tear down, the no that should have been yes. The no that should have been yes. Sometimes the market is wrong and the lesson is not in the rejection, it is in why it happened. Or a loop, vertical AI for logistics. Seed round at a 12 million post-money valuation. 2 design partners, 180,000 in ARR. Founder with Flexport background. That's a very important case study. The path, TAM too narrow. Logistics is a graveyard. Come back when you have 1 million ARR. And in reality, 14 months later, Aura Loop closed a Series A at 140 million post-money valuation on 4.2 million in ARR. Lead investor was a tier 1 fund. Investment multiple 11.7 times. 11.7 times. The lesson is not that the investor was foolish. Investors pass on great companies every day. If you guys are a big fan of Shark Tank, you know what I'm saying. For a fact, investors pass on great companies every day. The lesson is TAM is wrong is rarely the real objection. It is a polite way of saying we don't have enough conviction to champion this in a partner meeting. So again, a rejection is data, interpret it correctly and use it to sharpen your targeting, not your pitch deck. So the yes that closed in 3 weeks. Not because the pitch was perfect, because the preparation was. Mid-ledger, clinical workflow operating system. Day zero, first meeting, the founder opened with a 90-second narrative tied to a live customer ROI dashboard. Not a slide, a live dashboard showing real customer outcomes in real time. The partner asked for the data room link before the product demo even started. In day 9, partner meeting, the data room was already fully audited before access was even granted. 3 customer references were live that same week, including one champion call with the chief medical officer of a top 5 hospital system. Day 21, 22 million Series A signed at 110 million post-money valuation. What is the lesson here? What do you think? Speed comes from preparation, not pressure. The pitch was won in the 8 weeks of preparation before the first meeting, not in the room. The 3-week close is built in the 8 weeks before the first meeting. Start building now if you are a founder. And now we reach to Module 5 key takeaways. Module 5 key takeaways. And before that, I want to show you our last question for Module 5, which is visible right now to your right side. Which of the following is usually the real reason investors pass on a deal? A, the TAM was too small. The founders lacked partner level conviction and trust during diligence, or the company used the wrong valuation multiples. I'll give you 2 minutes and we'll have like 10 minutes for Q&As. I have already 4 questions on my list. I think we've been here for long enough to understand the investor pitch right now. Okay, let's head back right in. And let me tell you something very important. Okay? Before you leave this meeting or this masterclass, let me give you 4 principles. 4 principles. Not frameworks, not formulas, principles. The things that you will remember in 6 months when you are sitting across from an investment committee. Okay? Your pitch is not about your product. It's about de-risking an investment decision. Okay? Second, information gap is a barrier. Information gap is a barrier. You need to master it. You need to master it. Use a 12-slide sequence anchored by a bottom-up TAM and audited unit economics. You need to evidence and prove durable moats. And you need to master the active Q&A framework. Acknowledge, reframe, data, right? Bridge to strategy, correct? If you are a founder, follow the steps, the immediate actions on your right side. Before you leave, or before we go to Q&A, I have a surprise to all of you. On the occasion of our third masterclass tonight, tomorrow morning you will find a new free course on our website, ExecuFinity.com, that's titled Cash Flow Mastery for Executives. It's like 5 modules for 2 hours with a final 20 quizzes, and you must pass with 80% pass rate to get the certificate, but it's very, very, very insightful, valuable, and really advancing your career. So with this, we conclude our tonight session, and I will start taking the first question from the question box, and you all are going to see it with who even asked the question. We still have 8 minutes to go. And by the way, this link will remain forever. You can come at any time and watch the recording. It doesn't go anywhere. Same link we have here. Okay. So our first question. We have Ibrahim is asking, how should founders connect TAM to revenue, scalability, and capital efficiency? Okay, Ibrahim. Founders should connect TAM to one simple investor question. How large can this business become without destroying economics? A large TAM alone means nothing. Investor won't prove that the market is big enough, revenue can scale repeatedly, customer acquisition remains efficient as the company grows. The connection works like this. Large TAM, scalable revenue opportunity. Scalable revenue, efficient CAC, and capital efficiency. So smart founders don't just say our TAM is 50 billion. They explain it. Okay? They do explain it. I have one more question from Yasser Asiri. Yasser is asking, how accurate is LTV actually? LTV is directionally useful, rarely perfectly accurate. That's a very good question, Yasser. The problem is that LTV is built on assumptions about retention, churn, pricing scalability, pricing stability, expansion, revenue, customer behavior over time. So if you think of early stage startups tend to overestimate because they don't yet have enough historical data. A weak LTV model can become a fantasy very quickly. Okay? So because LTV itself is not the truth, the quality of the underlying behavior data is the truth. You get it? Now we have a very long question from Yasser. Yasser is asking from an investor's perspective. Let me read it correctly. From an investor perspective, how much weight do you actually put on them? Given that LTV is largely forward-looking and assumption-driven and CAC can vary widely by channel and stage, are these metrics treated as concrete decision-making tools or more as directional indicators that... Yes, sir, you're asking like 10 questions in one. Okay? But let me give you briefly. From an investor perspective, LTV to CAC ratio is rarely treated as a standalone truth metric. It is more of a diagnostic framework. So the real question becomes, what do these metrics reveal about the underlying business quality? With a limited historical data, maybe I put far more weight on retention behavior, gross margin, CAC, payback trend, founder understanding of unit economics. Okay? In very large stage, investing patterns recognition matters more than precision. Okay? So if fast CAC payback, strong engagement, organic pull, or efficient experimentation. The relationship between LTV and CAC becomes credible when a customer behavior stabilizes, acquisition channels become more repeatable, retention data matures over time. I hope it answered your question. And then we have Ibrahim. Why do institutional investors view declining marketing efficiency as a scalability risk? Because declining marketing efficiency signals that growth is becoming more expensive as the company scales. Because investors worry about rising CAC, shrinking margins, market saturation, because at a small scale, growth can be driven by how hanging opportunities or how low-hanging fruits are being picked. If each additional dollar of marketing generates less over time, scalability starts breaking down. And that is why. Okay, we have Saeed is asking if you can make a VC for startup companies course. If you look at our free courses, we have, looks like we have a lot of new faces here tonight. Right now, we have published 3 free courses. Finance for non-finance executives, private equity and venture capital, and boardroom-ready finance briefing in 10 slides. Take a look at ExecuFinity.com. Go to free courses page and you will find our 3 free courses. Tomorrow by 12 noon, you will find 4 free courses. Take your time, 2 hours, 10 to 20 quizzes, 80% pass rate, and get your certificate. I think we hit the time. MashaAllah, we reached 2,083 attendees this night. This was the biggest number I have ever coached in my life. Okay? I hope you enjoyed the session. I hope I added value to you. And I hope we can meet again in our new ExecuFinity master classes soon, inshallah. Go to ExecuFinity.com, take our 3 free courses, and if you care about our CFSP, our qualified program, Certified Finance and Strategy Professional, it will get launched, inshallah, officially July 1st, and that's our biggest and strongest flagship program. Certified Finance and Strategy Professional, 3 to 6 months program, self-study, 100% online. You do it on your own time. I hope you have a good night. Go take some rest. You all will receive your certificate of attendance tomorrow morning in your emails, if not tonight. The team is here and they will work on it. Thank you so much. Have a nice evening, and I really, really appreciate the time you invested in attending this masterclass. I hope you all can join me on LinkedIn, connect with me on LinkedIn, tag me in your certificates, and let's keep the momentum. Assalamu alaikum wa rahmatullahi wa barakatuh. See you, inshallah. Bye-bye.